Let's turn to Donald Broughton now for more on FedEx, the whole transportation sector, and what these numbers tell us about the health of the global economy. He is managing partner at Broughton Capital. Good to see you again. Welcome back.
Thank you. Good to be here.
I've already seen one analyst note tonight who's downgraded FedEx stock. He says, yes, global tensions and the trade war are a problem, but some of these problems that FedEx is experiencing are self-inflicted as well. What do you think?
Well, I think the time to close the barn doors before the horse gets out. Last week, we put out a report on Asia-Pacific air freight, signaling that it was down strong double digits and continuing to decelerate at increasingly alarming paces. Bottom line here is that FedEx has gone from, in just 90 days, from predicting moderate U.S. economic growth, from growth to moderate growth. They've gone from predicting, despite cost cuts and increasing the amount of those cost cuts from mid-single-digit declines in earnings for the year to 16 to 30% decline in earnings. This is not an alarmist company. It's a conservative company, well-run, global impact. And the bottom line is they are increasingly concerned because tariffs are terrible taxes, bottom line.
Now, FedEx obviously has a much more global footprint than some other companies in the transportation area. But do you anticipate that, given what FedEx laid out today, that we are going to hear more of this type of reporting from some of the other key transportation stocks and companies?
I do. And the reason we do is very simple. This is 1% of the weight of the economy, but it's over 15% of the value of the tangible goods economy. It drives tech. It drives hiring engineers. It drives investment. They move high-value, low-density goods. They move in the information age, in the technology era we live in, they move the driving force of the economy, both globally as well as specifically the U.S.
So do you worry about this sector? Do the decline in some of these stocks present opportunities yet, or what are you going to do with them now?
Well, on a case-by-case basis, there is definitely opportunities to look at best-in-class performers. But the bottom line is you have to have a view longer than a few weeks or a quarter or two, because in the short term, you're seeing continued dramatic declines in volumes. And even the best-in-class companies are going to struggle to produce improvements in earnings in that environment. And there's no catalyst to seem to stop those rates of decline as long as we have these tariffs in place.
Donald Broughton from Broughton Capital, again, thanks for joining us tonight. Appreciate it.
Always a pleasure.